I don't have a strong view over the next few weeks what it does. Overall, the on-chain indicators generally look pretty bullish at this time.
Crypto markets have been taking a slight hit this week after the enthusiasm on new Bitcoin ETFs has slowed down a bit.
First Bitcoin futures ETF made its big debut. The ProShares Bitcoin Strategy ETF dropped 5% since Tuesday's launch. Meanwhile, Bitcoin itself breaking out to a new all-time high before pulling back a bit.
Now, Bitcoin has breached new all-time highs recently, surpassing its previous all-time high in the spring. Some speculators are saying that, well, it's time for a pullback because that's what Bitcoin typically does when it breaches an all-time high. Others are saying, well, because of the recent momentum, it's too strong to issue a bearish narrative now. So where do you stand?
So overall, we already seen somewhat of a pullback. I mean, it went up to something like 67,000. It came back down to something like 60,000. It's been bouncing around. I don't have a strong view over the next few weeks what it does. Overall, the on-chain indicators generally look pretty bullish at this time. Now that we have Bitcoin ETFs, there's, you have to watch the futures markets as well. It's gotten more complex in order to map the kind of intermediate direction for Bitcoin. But overall, I'd say that the bullish case is in my view a lot stronger than the bearish case when looking out, say, 6 months.
And I think people have to be somewhat cautious because, yes, a Bitcoin ETF could be a very bullish case, but it's also providing investors another avenue to short Bitcoin, right?
It provides an avenue to short it. It also provides arbitrage, right? Because you can short the futures and buy the spot, which all else being equal is pretty good for Bitcoin. It also basically makes it so that because those futures are cash settled, you potentially have a rehypothecation issue, which is something gold has faced over the long term. And so there are some advantages and disadvantages. I think the overall advantage is that it showed that the SEC is at least somewhat on board with Bitcoin. We've seen spot Bitcoin ETFs in other markets. The SEC hasn't gotten there yet, but a futures based product kind of reduces, I think, in investors' mind the perception of a regulatory crackdown in the United States, at least. And we're also seeing more regulations around banks being able to custody it, banks getting into the space. Basically, it's kind of hitting critical mass in terms of regulatory acceptance, which I think is important for some of the large pools of capital. So even though I personally wouldn't want to own a futures-based Bitcoin ETF, I think there's an important signal there to big allocators.
Okay, finally, I want to ask you about the concept of a Bitcoin or a crypto winter. I've heard this from several analysts I've spoken to. Last time we had a high in 2017, the Bitcoin price corrected by a tremendous margin and then stayed flat for a number of years before regaining its strength earlier last year. Do you think that could happen again this time, next year?
I think it certainly could happen. There are a couple factors that I think are different this time. Because remember, that's a pretty small sample size. Bitcoin's been around for 12, 13 years, and it goes through these 4-year halving cycles. So those winters occurred kind of in the second half of a halving cycle. Certainly in rate of change terms, that's something I'm monitoring, and that have basically had a stagflationary outlook since we've entered quarter 3. And so basically, if you look at most types of economic growth, they're still positive but decelerating compared to their peak in quarter 2, while inflation has obviously ramped up. And historically, one of the triggers for economic weakness tends to be very, very high energy prices, and we've seen that in the United States to some extent. Then especially we're seeing it in Europe and China, where high input costs can trickle through the rest of the economy and force contractions. We're also seeing supply chain shortages, and so we're in an environment where, if anything, inflation is partially being masked by shortages. So if there's a shortage of something, the price it doesn't get fully reflected right away. And so basically customers and businesses are dealing with lower quality in their supply chain situation, in their service offerings, while still dealing with pretty high prices.
Okay, and how does that translate to real assets? How does stagflation directly impact, let's say, the stock markets or cryptocurrencies or precious metals?
So stagflationary environment obviously can be somewhat challenging for the stock market. It's also generally rough for the bond market. So right now we're seeing in bonds, for example, that yields are well below the inflation rate. So anyone holding cash or bonds is getting devalued over a period of time. And with stocks, it's kind of hit or miss. Obviously, the financials and the energy sectors are doing pretty well. whereas you've seen some weakness out of some of the more highly valued unprofitable tech stocks. Basically, stock markets have been a mixed bag, especially when you look globally. And so those are the areas where there's certainly risk to the downside. Commodities tend to be some of the best performing assets in stagflationary environments. It's important to realize, though, that they're volatile, so it's not a straight line. So even if you invested in commodities in the 70s, which obviously did very well, there would have been some wicked drawdowns during that time. And so that's kind of the area that I'm focused on is more that commodity area, more of the value stocks, the real assets, appropriately priced real estate in some markets still. I think there are attractive hard assets out there as part of kind of an overall portfolio mix.
Okay, we'll be talking about inflation hedging in a little bit more detail in just a minute. Backing up, let's talk about your global outlook. I've named one of the risks that investors are watching, stagflation. But generally speaking, Lyn, what are the major factors that might impede growth that you're watching out for? The major risks in the economy, so to speak.
So I think the major risks are these energy shortages that we're seeing, which is kind of the catalyst for stagflation. We also have to see how different central banks start dealing with the fact that they have inflationary environments. And so one of my big themes going into this year was that we probably would get substantial inflation, but yields would still be pretty low, because that's essentially what happens when you have public debt as high as this is, which makes it a very different environment than the 70s. So in the 70s, debt as a percentage of GDP was very low, so they were able to raise interest rates very, very high to counteract inflation. Whereas if you go back to, say, the 1940s, when you had all that war debt, when they ran into high inflation, they just pinned rates near zero anyway and pretty much let some of it burn away in inflation. And so I kind of am looking at that situation, but a risk is that if they do try to tighten, which they very well might, that could obviously put some downward force on risk assets across the board. And that goes back to this thing where inflation is rarely a straight line. There are all these pushbacks against it that happen along the way. And so investors have to make sure that they understand their time horizon if they're a trader or an investor.
So you're expecting real interest rates to drop then. If the yields remain low and inflation remains high, isn't that negative for real interest rates and perhaps positive for gold?
So I view real interest rates as likely being negative for a long period of time. Whether or not they go lower than now, I think is hard to say. But I think my key thesis is that they'll be persistently negative. And that there's obviously a certain risk that they go lower. So one of the things we're seeing in the United States, for example, is that shelter inflation is picking up. And so rent inflation and owner's equivalent rent inflation, they have not been large contributors to that initial inflation spike we had, but they're now driving a lot of it. And so they're about a third of that CPI basket. And so that's part of why it's going to be sticky going into 2022. And then, of course, from there, we have to see what happens with the energy cycle, with some of these other demand sources and supply chains.